This conference will now be recorded.
And I mentioned to you on the first day of class, what you were learning how to do was, the main purpose of this class was to learn how to prepare an income statement, statement of retained earnings, balance sheet, and eventually a statement of cash flows. And so those were the things that we were trying to get through at midterm. And we're testing on it, and we test on it again at the final. But these are your major takeaways from the course. We mentioned the users of financial statements, and there are a lot of external persons, investors, creditors, and bankers that use financial statements. And now we're going to go back and look at the theory behind what we've been doing. And statements have to be fair and objective, and there has to be rules that are followed so that all companies are theoretically doing the same thing. And so after the Great Depression, the Securities and Exchange Commission was created to set out basic laws or basic rules on how accounting statements were to look and how they were to be prepared, because people were then having the rules and everybody was doing everything. Then we have Financial Accounting Standards Board. These are the professionals and educators who supplement the SEC and do most of the work now in preparing the accounting standards that we utilize in preparing the statements. Then we have the Governmental Accounting Standards Board. You can remember a lot of municipal agencies went bankrupt because they were doing anything without rules. So they prepare rules. And then we have the International Accounting Standards Board, and they prepare rules so that the standards are uniform worldwide. So these are the four agencies that prepare financial statements, and you should be familiar with those agencies. You won't be tested on this until the third grading period, but we're looking at it now. There are 15 generally accepted accounting principles that I've laid out that I want you to be familiar with. The first, the business as a single entity concept. And so when you create a business, it's separate from the owners. There's you personally, and then there's your business. And most times we utilize a corporation so that we will have limited liability as we operate. And we looked at this a little bit earlier. So specific currency in the US, we use US dollars. If you have international operation, you got to convert to US dollars. So your statements will be uniform throughout. You can't use US dollars in the US and then combine those statements with, say, a country like Mexico, whose dollars, who uses a different currency that is not at the same, got a different evaluation method. And so that conversion has to occur. If you have a Chinese company, you got to convert those statements to US dollars so they will be current. Time periods, typically we look at a year. And then very importantly, historical costs. You cannot prepare statements based on estimates. You have to use, if it costs you something, that's what you got to use. So if you buy land for 100,000 and you make that journal entry to record it, just because you think it's worth 2 million now, you cannot write it up to 2 million. That was one of the big things. How do you know it's worth that? And so we utilize historical costs. Full disclosure. If you prepare financial statements and something is going to impact you, such as the major oil spill in the Gulf, BP, when it prepared financial statements, had to say we have a liability that may occur. Companies today, when they prepare financial statements for the 2020 year, they've got to indicate in those statements how the virus may affect their operations, if at all. Okay. Then there's the recognition principle, which states that companies recognize income and expenses in the same period in which they occurred, not when paid. So we have this recognition principle that you're going to recognize revenue when it's earned, and we talked about that with journal entry, 15, you recognize income when it's earned. Going concern concept, there's a need to make sure that the business is going to continue in operation. If not, you got to use liquidation values. Matching principle, which leads us into the adjusting interest today. We have to match expenses and revenue. And so if we get toward the end of the year and workers are paid the following month, but if the workers generated revenues of $400,000 and the salaries that were incurred was $75,000, even though the $75,000 won't be paid until 2021, because we recognize the income, we will recognize expenses because we got to pay taxes on the income. And so we want the related expenses to be there also, so we can net those out. So the matching principle, we match expenses with the revenue generated. Materiality, we don't correct every $10 error when we're running a business, but because it would take too much to correct everything. You got a multi-billion-dollar business. So they may just waive things under $10,000. We always want to be conservative. We're gonna err on the side of conservatism when we're looking at financial statements. So we aren't going around making guesstimates of what the income may be. We're gonna look at what it was. Sometimes industries will have special rules. Oil and gas industry has special rules that they go by. And so banking, insurance. And so sometimes there are special rules that we look at. Consistency, you got to use the same principles from period. If you're doing something one way, 1 year, you got to do it the same way the next year. Objectivity, you need to have objective information about what you're doing. And then accrual basis accounting, we've talked about this as once again, journal entry type 15. We accrue income when it's earned. That's going to be a better reflection of what's happening. If we earn it, that's fine. You just got to make sure you're matching the expenses and the accrual is going to be collected eventually. Then we do have to assess the cash flow prospects of company. So this is some theory that you should be familiar with. There should be some multiple choice questions in this section. Eventually, starting on page 21, you should practice on all of these multiple choice questions so you can, in your next examination after the midterm, so it's not in this period yet, you got plenty of time to look at this and be prepared for it. Any questions?
So when are you going to start incorporating multiple choice questions?
When am I going to what?
Start incorporating multiple choice questions.
Grading period 3. Grading period 3. Okay. Adjusting entries. adjusting entries, and we skip this part of the accounting cycle. You know, we work with the accounting cycle, we analyze transactions, and then we post it to the ledger. Well, we analyze, journalize, then we post to the ledger. We prepare the trial balance, and then from the trial balance, we jump to preparing the financial statements so that you'd have some sense of that. And so we didn't introduce adjusting entries because we wanted you to be able to concentrate on and be able to prepare financial statements because that's the main focus. And now we're coming back to adjusting entries where, given that you have a trial balance, you will make certain, adjusting entries. And adjusting entries are journal entries. So anytime there's a journal entry, there's a debit and a credit, and it has to be posted. There's a debit and a credit, and it has to be posted. These entries are typically made at the end of the period. They're trying to make sure that the balance sheet has the correct balances for all the accounts, and that all expenses and revenues are recognized on the income statement. So adjusting entries allow us to utilize accrual basis accounting. If we didn't make adjusting entries, then we would be on a cash basis, and that would not be the best reflection of what's going to, what happens. And types of adjusting entries, we'll look at these, but this is just sort of a summary sheet that I put in here for your own adjusting entries. Okay. Let's see if we can get the rationale behind adjusting entries. If you go to the store and you buy 10 steaks, whether you pay cash for them or whether you use your credit card and you put them in your refrigerator, they are an asset. They're an asset. Now, once you start to eat the steaks, then they become an expense. They're no longer an asset. But as long as they're in the refrigerator fresh, they're an asset. You'll recall that we had that practice problem, that demonstration problem. And in this problem, we had two purchases of supplies. We bought supplies for cash, where we debited cash, debited supplies and credited cash. Then we bought some supplies on account, where we debited supplies and we credited accounts payable. So we had a 7 and a 12. So right now there's $9,000 in the supplies account. Okay, the company goes through and does an inventory, and they find that supplies, there's only $3,000 in supplies now. So even though there's 9,000 originally in supplies, there's only 3,000 now. So what are we going to do? We're going to make an adjusting entry. We have these two, and we just call them preceding entries because they've already happened. But because we only have 3,000 in supplies left, we no longer have 9. We have to make an adjusting entry, debiting supplies expense and crediting supplies for 6,000. When we bought the supplies, we had a debit of 1,000 and a debit of 8,000 in the supplies account, so we're at 9,000. But we no longer have 9,000 in supplies. We only have 3,000. So we take the difference and we make an adjusting entry. And once we make that adjusting entry, supplies are now at $3,000 and the supplies expense is $6,000. That is an adjusting entry. What would happen if we didn't make the adjusting entry? If we did not make the adjusting entry, the asset supplies would have too much in it. And the expenses would not be high enough. They will be understated. So a couple of things we're looking at. When we have an adjusting entry, it's always going to involve both a balance sheet account and an income statement account. So you always have a balance sheet account and an income statement account. And it gets those balances correct. Let's see if there's anything else we want. I think we've covered those. But one thing I'll say, in these preceding entries, 7 and 12, we could have had cash, accounts payable in the entry, and then, because we eventually gonna have to pay for this, but when we make the adjusting entry, and in an adjusting entry, we do not have the account cash. I'm gonna say that the second time. When you make an adjusting entry, the cash account is not involved. And I'm gonna say it a third time. When you make an adjusting entry, is not the cash account that's involved. It may be a preceding entry, but when you make that adjusting entry, we don't have cash. So team one, when you're setting this up for next class period to present it just like this. Your preceding entries that happen, and then the adjusting entry that is made. Sometimes you're going to have a balance already in the account in some of those entries. Okay.
I have a question.
You said sometimes we're gonna have a balance in the account.
Yeah. You could have already had $2,000 in the supplies account. Okay.
So when you make the adjusting entries, do you make them on the original journey entry page? Like,
right
like
there.
originally we go through like 1 through 40 on the assignment, like, okay, such and such had a cat, like made a transaction or whatever. So when you go back at the end and make adjusting entries, do you put it on the same journal sheet or do you create a new journal sheet?
Same journal sheet. And in fact, closing entries actually go on the same journal sheet. Yeah, just kind of separated them for spacing, but and it kind of doesn't matter because you got to post them and you only got one set of T accounts. You only got one set of T accounts. So eventually they got to be posted.
So one journal sheet and one set of T accounts.
Yep. Because there's only one set of T accounts. Okay. Any other questions on adjusting entry? And we'll get to some beginning balances in there in a second.
So what happens, like, I see you have the supplies expense account, right? But like, suppose earlier, like, there was like another question about like some similar to this, like we already had a supplies expense T account and we have to like list, like how you say, the 6,000 under that same account. How would it be closed out then if there's like the difference that we're putting it in it and then plus the transaction before? Like, how would you be able to tell? Like, that's kind of what's confusing me, because I understand about the supplies, like how you have it differentiated, like the adjusting journal entry on one side and then the 3,000 for the balance. But because you have to have the two accounts, the supplies expense, like if we have a question that already like says there's a supplies expense? Like, how do we close that out? Because for this instance, it's just one question, but I'm pretty sure that there are going to be like some other questions that use the same account.
You know, I would think, on a personal note, I would think that doesn't the adjusting entry come before the closing entries? They supposed to?
Yeah, they have to come before.
Oh, okay.
They come before closing. We just
I think we just learned it backwards, but I think it do come before. Yeah.
comes before. Students typically have had a lot of problems with adjusting entries, so I try not to test on adjusting entries before midterm, so I don't have to worry about that. But let's just change this problem a bit, and let's assume that we had a beginning balance of $2,000 in the supplies account. So at start of period, that's $2,000 in it. Then in the current period, we have 1,000 and we have an 8. And so now the balance in here would be what? 11,000, okay? And so if you had 3,000, then this would now become what? 8,000. So just showing you if you had a beginning balance. And this would be 8,000. Now, so as we look at this, like I say, you can have a beginning balance. You don't make a journal entry for the beginning balance. That journal entry has already been made. You only make the journal entry for the new purchases. Then we make the adjusting entry. Then, as was discussed, when we get ready to do the closing entries, they're going to come next. So a lot of times, you don't have anything in the supplies expense until you make this adjustment, or if you did, that's fine. But as part of the closing entries, we would come in here and credit this for $8,000.
Oh, okay, I see. Because what was confusing me was that, like, yeah, like you were saying, we're kind of learning it backwards, but like I understand why you did it. But so this always comes before the closing entries. So that's why we
Adjusting
close
entries
it out.
come before the closing entries. And like I say, I did this because, we're trying to get an overall sense. And now we're coming in to put in some of the final, the finishing touches on this now in terms of more detail. But if you look at this accounting cycle, we analyze the transactions and we make the journal entries, we post to the ledger, and we prepare a trial balance. So we did 1 through 4. I skipped 5 and 6 because once you prepare the trial balance, if you make adjustments, then the trial balance has got to be adjusted for the adjustments. Not a big deal. And then with that adjusted trial balance, you prepare the financial statements and closing entries. So the adjusting entries are always, prior to the closing entries. But rather than go into the adjusting entries, which has a tendency sometimes to stop people because we've already done journal entry, then we're gonna make some more here. Sometimes that has been problematic. But as we work problems now, you'll have both, and so you'll have the regular journal entries, and then the adjusting entries will come in. Okay. Any other questions? And those are good questions on what we did. We bought supplies. The supplies are gone, so it becomes an expense. The other thing is that all assets are basically prepaid expenses that need to, they're going to eventually end up on the income statement as an expense. And so they need to be generating cash. So a business does not buy assets unless they can generate cash, because eventually you're going to have to take them, when they're utilized, you got to take them off of here and put them on the income statement. This is an expense.
Okay, so wait. When we're doing like the trial balance and stuff for this, we would be listing supplies under the asset at 8,000 and supplies expense at 8,000 too, like under the expenses part, or are we just listing one of them?
Remember, we had 11,000. Once we made the adjusting entry, supplies would be 3, and supplies expense.
Oh, so the supplies asset would be 3, and then the supplies expense would be 8,000. So that's what how we would list it under like a trial balance.
Correct. The accounts,
and then when we would go on the income statements too.
Accounts in the same order as the chart of accounts. And yeah, so everything's in the same order. So we're just simply adding in some more entries, more accounts, but the location is is going to be the same.
Oh, okay.
Okay, so there are 4 types of adjusting entries. Prepaid expenses, which we just looked at, where you have a preceding entry to acquire something. Then when that asset is used up, we make an adjusting entry to transfer it to the expense account. So this is mainly team 1. Team 2 will get some of these. Then we have unearned revenues where we get cash in advance. So we hadn't done the work, but we still have the asset. These are called deferrals, if you can see them, because you've already either paid for the item or you already have the cash. Okay. Then we get to the accrual side. 3 should be in here. Accrued revenues are revenues earned but not yet received in cash or recorded. This is typically a journal entry 15 type of transaction. You've earned the revenue. Then there's going to be a subsequent transaction to collect the cash, which is a type 3. So we've already done this. We didn't say it was an adjusting entry, but that's kind of, the impact of that is same thing. Then we have accrued expenses. These are expenses that are incurred but are not yet paid. So we record the expenses. They're going to be paid the next period, but we have to recognize the expense in the current period. So these are the 4 types of adjusting entries. And we're going to look at each one. Prepaid expenses, items that are assets initially, but an adjusting entry needs to be made to put them on, to move that item from being an asset to being an expense. Unearned revenue. And these are the 2 we talked about today. You got money in advance. And so with the unearned revenue, you already have the money, and you're going to get the item later. So let's look at an example of unearned revenue.
Real quick, I have a question.
Yeah.
So just in the future, when it comes time to make adjusting entries, will we know which accounts to adjust, or do we have to figure that out? Like, will it be something kind of like, hey, adjust these accounts? Or
Typically, what's going to happen is it'll just be a transaction type. I mean, it'll be a transaction statement. Make the adjusting entry. This is such and such is happening. So you know it's an adjusting entry. You know that.
okay.
Let's look at unearned revenue. And with unearned revenue, a lot of time people want something such as a gain. So to make sure they get the gain, they go and pay for it in advance. They go and pay for it in advance. The company, GameStop, is very happy because they got the cash and they hadn't done any work yet. So when they do that, when they receive the cash in advance, they're going to debit cash and credit unearned revenue. They're going to debit cash and credit unearned revenue. And they're just so happy that they have your money. Unearned revenue, if you look at your chart of accounts, is a liability account. When they get the gains in and give the gains to you, then they recognize the revenue. But they really don't mind you paying them in advance. And they have your money and they have unearned revenue. But the gains may not come in. You may ask for a refund. And so they put it in a liability account until you show up to get it. So let's see if we can. So let's look at this. Unearned revenue occurs when a company receives cash prior to the performance of the service or delivery of the goods. And so we're going to have a prior entry to debit cash and credit unearned revenue. Unearned revenue is a liability. Airline and magazine publishing companies a lot of time get cash in advance, and they love it when you pay in advance. When the services are performed, then an adjusting entry is made, debiting the unearned revenue and crediting sales or revenue. Prior to the adjustment, the liabilities are overstated and revenue is understated. So assume GameStop collects $50 in advance from 200 customers, okay, for games. That will arrive in 2 months. 2 months later, the games arrive and are picked up by the customers. The following entries are going to be made. When they get the cash, $50 from 200 customers, they make an entry debiting cash and crediting unearned revenue. A preceding entry, type 4. Okay. Unearned revenue is a liability account. Now, when they deliver the games, then they're going to debit unearned revenue and now credit sales. So now, up until this point in time, when the 10,000 is here, it's a liability, just like accounts payable and notes payable. Revenue is not recognized. But once they deliver the games to the customers, then they debit the unearned account, kind of a holding account, and credit revenue. And now this revenue will be on the income statement. The revenue will not be on the income statement when they get the cash. So once they then go ahead and deliver those games, then they're able to make an entry, debiting unearned revenue and crediting sales. So the statement documents is going to be, so many customers games were picked up by customers, make the adjusting entry. So there'll be this preceding entry, then an adjusting entry. And of course, you can't have an adjusting entry if you didn't have a preceding entry, of course. Once again, note that cash is not in the adjusting entry. It may be in the.
And you said unearned revenue is supposed to be on the income statement. What were you saying about that?
Unearned revenue is a liability. Look at your chart of accounts. You're always supposed to have your
Oh,
chart
okay.
of spending. If you get cash and you hadn't done the work, you can't report the income. You got to make this entry debiting cash. You got 10,000 in cash. You just showed us unearned revenue, and GameStop is very happy with that. When the games come in, they give the games to you. Then they close out the revenue account and put it in revenue. But it's not revenue until they deliver the game. So all companies who operate this way, where they receive cash in advance, they use unearned accounts. Okay, layaway is kind of similar to this also. Berlin Coat Factory. Give us your cash. Give us your cash and pay on it. And so they debiting cash and crediting unearned revenue. Now, once you finish paying for it, and they give you the code, then the revenue, it moves from the liability account to sales. But it's holding there in the liability account until they deliver the item. It's not revenue, so you can't prepare an income statement showing this as revenue, because you haven't performed the services. So to recognize revenue is not a matter that you got cash, but you got to perform the services too. So because you haven't delivered the goods, you cannot recognize the revenue. The earning process must be substantially completed. You've delivered the goods. So cash in advance does not create sales on the income statement. Any questions? So team 2, this kind of comes in your purview. We may start on you all first. Okay, let's get up here to team 1. And once again, important rules for adjusting entries. When we're recording adjusting entries, remember these things. Cash is never involved. Second, adjusting entries also involve either a revenue account or an expense account and a balance sheet account. So it's always going to be an income statement and a balance sheet account. Okay, so just keep that in mind. Let's look at prepaid expenses. Every item other than cash and receivables, inventory, supplies, prepaid insurance, all of those items, equipment, are prepaid expenses. When you buy the item, it's an asset, but then it'll be utilized. Once it's utilized, you got to take it from being an asset and make it an expense. So we make the preceding entry to record the acquisition. As the item expires, with time or through usage, we make the adjusting entries. If you did not make adjusting entries, assets would be overstated, expenses would be understated. Okay, so if you don't make adjusting entries, your assets are overstated and your expenses are understated. This adjusting entry is going to require a debit to an expense account and a credit to the asset account. So when we have prepaid expenses, team 1, when you make that adjusting entry, you debit an expense. Okay, it might be supplies expense, it might be insurance expense, it might be depreciation expense. But when you make that entry, you are debiting an expense. Okay? So typical prepaid expenses, supplies, insurance, autos we've been buying, buildings and equipment. Because what does an auto do? It goes down in value. So once it starts to decline in value, you got to reduce the value and recognize an expense. So let's start with the supplies one. Supplies, paper, pens, when we purchase them, we debit the asset account. Rather than record paper and pens as they're utilized day by day, we're going to buy the supplies and put them in the supplies account. At the end of the period, we're going to take an inventory and we're going to make an adjusting entry. Now, you could make an entry every day recording how much paper and pens and supplies have been utilized, but that would be unnecessary journal entries. So when we buy the supplies, we debit supplies and credit cash in this example. When we do our inventory, it's only $2,000 in supplies less. So what's our adjusting entry going to be, Dawkins?
So you're gonna have supplies and then supplies expense. So for the supplies account, it's gonna be the balance you said was what, 5,000, but then there's only 2,000 left at the end. So that means that the adjusted entry is 3,000.
That's correct. So you look at it as kind of like a bank account. If you had 5,000 in your account at the beginning of the period, and you only got 2,000 at the end, how much did you spend?
You spent $3,000 you spent 3,000.
So we're going to debit supplies, expenses, credit supplies. So hopefully maybe you're kind of getting a sense of why I skipped this. Get more of a sense a little bit later. And so supplies has 5,000 in it with this preceding entry. And then when we make the adjusting entry, so this should be 3,000 here. That should be 3,000. So it would be the adjusting entry 3,000. And then you would eventually now close this out. So eventually you'd make a closing entry to close it out. But right now, all we're trying to do is to make the preceding entry and then the adjusting entry. When you make the closing entry, there's still only 4 closing entries. There's still only 4 closing entries. And so supplies are going to be closed at every other expense. In which closing entry?
The second one.
Closing entry 2. So it's going to be there with
Oh,
all
I
the
thought you were talking about the third. I thought you were talking about these.
So what?
I thought you were talking about the putting the supplies expense. You know, when we're doing the closing entries and there's like 4 type of accounts. You have the first one that's like the
There are
income
4
summary, and
types
then the
of
second one is
closing.
listing
There are 4
the
types
second
of
one like
closing.
lists all the expenses.
I guess she figured. There are 4 closing entries and not 4 types of accounts. You have to close everything from dividends on down. It might be 3 or 4 or 5. It might be 20 closing entries that you'll close.
Um.
Okay? But you got to close if you look at your chart of accounts, every account from dividends, income summary, and everything on the right, if you got an amount in it, you got to close it.
But that's what I'm talking about. I was talking about the supplies expense. Like, you know how we would list that under the closing account under the second type, like how there's the
Correct.
income summary and then all of the expenses that you list so
Correct.
that they can close out right. That's what I was talking about.
Okay. Now, let's look at insurance. Insurance, everybody here got auto insurance? Okay. A business buys insurance to protect from losses due to fire, theft, unforeseen events. Just like with your insurance on your car, you got to pay for it in advance. As the insurance expires at the end of the period, you're going to make an adjusting entry to reflect how much is expired. So let's assume on April 1st, a company buys a 12-month insurance policy paying $24,000 on April 1st. What journal entry would it make?
Prepaid insurance.
So debit prepaid insurance and credit
And
cash
cash.
for 24,000. This entry occurs on April 1st. We get to December 31st, you got 24,000 in insurance, but some of that insurance has been utilized. In fact, how much has been utilized? It's a 12-month policy, so what's the
A
insurance?
year?
Yeah, it's 24,000 for the year, and it's a 12-month policy purchased on April 1st. So if you got a 12-month policy on April, then it's what, 2,000 a month, okay? Does that make
Right.
sense? It's 2,000 a month. So you paid 24,000 on April 1st. If you wanted a refund on December 31st, how much could you get? If you wanted to cancel on December 31st.
That's what, like 18,000 or like 9 months? Was that 9 months from then?
14,000, 14,000,
So what?
Oh yeah,
14,000,
sorry.
$12,000, one of them.
Well, if you
It's
buy
nine
something
months
on
times
April,
two, right?
buy it on April, like Dawkins is saying, from April to December, it's going to be 9 months. You got
Yeah,
to
so that's
count
like 9 times 2. 9 times 2,000, that's 18, right? 18,000.
1,000. So you're going to make this entry: debit and insurance expense and credit and prepaid insurance for 18,000. That's the adjusting entry. Preceding entry, adjusting entry. So insurance had a balance of 24,000. And so the adjusting entry is made, and now you get 6,000 back. We now have insurance expense with $18,000 in it. So these accounts may not have anything in them until you make the adjustments, unless you're doing it monthly. And it could happen monthly, but it's the same process. So now you'd have another account to close out documents. So not only supplies, but expense, but insurance expense. So any question on insurance? All we did was we paid 24,000 for a 12-month policy on April 1st. So since it's a 12-month policy, it expires at the rate of 2,000 a month. Okay. And so expiring at the rate of 2,000 a month, we expense 18,000 of it. The insurance is no longer worth 24,000. It's only worth 6,000. You've already utilized the other insurance. So 24,000 divided by 12 months gives you 2,000 a month. Since 9 months have elapsed, 18,000, 2,000 times 9 is the calculated expense. So once again, I skipped this because, I had individuals, who were not clear on the first set of journal entries we worked with. So I did not want to bring these in.
So when we're writing this, like on a trial balance, like the prepaid insurance, do we like it's still debited, right? Like prepaid insurance is still debited, although like on the journal account you have it credited, but that's just for the purpose of like closing it. Well, not closing it, but
Just remember, you can have debits or credits in any asset account. Cash has debits and credits. You just want the balance to be a debit. Got it?
Okay.
Any account, any asset account can have debits and credits. It just needs to end up with that balance being that.
So for the balance, like on a trial balance, prepaid insurance will be 6,000 and insurance will be 18,000,
Correct. Insurance expense.
and both of them debited. Okay. Okay.
Now let's move on to long-term assets. such as autos and equipment. So we can get through that, then we'll come back to supplies again to make sure everybody can do supplies. So everybody's goal today is learn how to do supplies. Okay. So we're gonna come back and make sure see if everybody can do supplies. Let's look at long-term assets such as autos, equipment, buildings, and other prepaid assets that are gonna last longer than a year. Similar to that insurance. When you drive a car off the lot, what happens? You buy a car, you drive it off the lot, what happens? Goes down in value.
It depreciates, yeah.
Depreciates in value. So if you buy an auto for your business, you gotta depreciate it. And you just saw what, where a certain person took depreciation and what? It wiped out all his taxes. The same depreciation. Okay? So suppose we had an auto that cost $30,000. We paid $3,000 down, and it has a useful life of 4 years. So if it's only gonna last 4 years, we're gonna have to write off 30,000 divided by 4, or $7,500 a year. Okay, so we got the car, it costs 30,000. So let's just see what's the journal entry gonna be to purchase the car.
Auto debit, cash, credit, 30,000.
Well, we said you only paid 3,000 down.
Yeah.
This is y'all favorite entry here. So we debit cash 30. Excuse me, debit auto 30, credit cash 3, credit note payable 27. Can everybody make this journal entry?
Yep.
Okay.
Yep.
Good. Okay. Now we need to make the adjusting entry. And when we have long-lived assets, we always want to know what the original cost is. Okay. And so we're going to make an adjusting entry document, debiting depreciation expense, and we're going to credit accumulate depreciation auto. So we're debiting depreciation expense. That's where we putting the write-off at, but we crediting the account accumulate depreciation auto. And so when we do a balance sheet presentation on long-lived assets, we always want to know what they originally cost. So we put in here an accumulate depreciation account, which is going to have a credit balance. And so it's going to reduce that cost to $22,500. So we will always know that what the item costs and how much depreciation has been taken on it. See that credit balance, Zahid?
By balance sheet presentation, you mean that when we put this on the balance sheet, that we have to make sure we put a depreciation on the asset side too?
This is the write down. Remember, when we did the supplies or the insurance, we went straight against the account and reduced it to $6,000 because it's a short-lived asset. When we have long-lived assets, we keep that cost of $30,000. We show how much has been written off, and we subtract that to come up with the same thing. So we could have credited auto here. Okay, we could have credited auto for $7,500, but we wouldn't know what the auto costs. And on balance sheets, it's important to know how much long-lived assets cost and how much depreciation has been taken.
So basically, how much you originally bought the stuff for, less than,
Right.
okay, how much value it lost over time.
Correct. That's what we do. So auto in the T account is always going to be at 30,000, but accumulated depreciation is what's called a contra asset. It's a contra asset. It has a credit balance. So when you prepare a balance sheet, well, first of all, when you prepare a trial balance, it has to have a credit balance on the trial balance. Or you want balance. So now if I give you some accounts and there's accumulated depreciation, you have to know, wait a minute, that's not a debit balance, it's a credit balance to balance. And now we have depreciation expense. So now we have another expense account that eventually will be closed. Any questions? So once again, maybe you're seeing why I delay this until after you do your financial statements.
Yeah, I have a question.
Yes.
So eventually there will be a balance sheet made after you post to the ledger and make a trial balance or whatever. And I
Correct.
noticed on the income statement when we have sales, we less sell like if we have anything like a sales return, we'll less that and they'll give us the we'll less the sales return and the expenses to come up with a net income. So when you put stuff like this, like auto is an asset, so it belongs on the balance sheet.
Correct.
When you credit the accumulated depreciation, is that something that you need to put on the balance sheet as well?
Yes, because it's valuing the asset. It's going to tell us that. That's why we got balance sheet presentation documents which your group has to present tomorrow. Cost less accumulated depreciation gives us the net book value, gives us the balance sheet value. So these two accounts go together on the balance sheet.
But okay, so for the 10 questions, what are we actually taking them from? Like, are we taking them from the 1 through 40? Are you listing like just plain just the
Your team has
plain
your team has 1 through 10.
of what I'm saying, like of 1 through like of the 1 through 40?
There are 43 adjusting journal entry questions. That's the
That you
first.
posted,
So what?
that you're posting on Blackboard, or like of something that we've already did
Then the primer.
in the primer? Okay.
Yes. And so what you've got to do is you go to that first, I'll go back. Let's see if we can get to it right quick. On something like page 83, adjusting journal entry study problem 3-1. And you need to make sure everybody on your team works one. So in this case,
Okay. So do we like need to make a balance sheet and all that? Or are we just doing the
no,
journal? Are
all
we just
you're
doing
doing
the
is what we
adjustment?
just did. All you're
Okay.
doing is what we just did. You're making the preceding entry, you're making the adjusting entry, and then you're listing those T accounts, and you post them to the T accounts so you see what it looks like. So it's looking just like what we did. Okay.
Okay, and there's like the journal, you know how we list the journal entries? Is there like a chart like that we can list all 1 through 10, or do we have to do them like one by one, like how you were showing us the example
Yeah,
before?
one by one is probably the best thing you need to go.
Yeah, because it would be too much all in
Because
one.
let's look at your first one, Dawkins. We have J rental car.
Right.
2017. Then we moved to 2018, okay? So you got to have 2017 done first. Then it's going to carry over to 2018. Okay? So every time you got one, 2017, then 2018, 2017, then 2018. So you need to do them in order. So bottom line, you need to do them in order.
You said we need to do them in order, but like you mean like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10.
Yes, yes, yes.
Okay.
Okay, so looks like we're just simply going through the depreciation one. So we're just going through 1 through 20. So I guess team 3, you've got that unearned income, which we've already covered. So most of them are, are going to relate to prepaid assets. Okay, most of them are going to relate to prepaid assets. Because that's what you have, a whole lot of prepaid assets that you have to work with. Okay. Your income statements now will begin to look like this. So we just had some simple ones before. Sales, less cost of goods sold, gross profit. Operating expenses, you list all of those you have. Total expenses, net income before taxes, income taxes, net income after taxes. So we're basically will stop here. But this is how your income statement begins to change. Statement of retained earnings stays the same. But on the balance sheet, you got a year 1, year 2. And you'll see that here you have accounts receivable, less the allowance for bad debt, another contra account, net receivables, total current assets. Then your property, plant, and equipment, less the accumulated depreciation, net, goodwill, total assets. So we begin to get into a little more detail. So you need to go back to these pages now to look at how your balance sheet needs to begin to look and your income statements, etc. Okay? Are there any questions by anyone? There are no questions by anyone? Well, you know what that means, right?
Sure.
I
When
got
you
a
gonna
question.
post on YouTube?
Yes, it's being recorded, so we'll have it on YouTube today.
Please, sir, because I really wanna.
Well, let's give Dawkins and her team some help. Jay Sharon, that's their first. In 2017, purchase supplies on account costing $25,000. At the end of the year, supplies on hand totaled $5,000. On everybody take out a sheet of paper and record the preceding entry and then the adjusting entry. So I want everybody to take out a sheet of paper and record the preceding entry and record the adjusting entry.
For what number? I forgot. All right.
Number 1.
Oh.
We do it the first one. Can everybody make the preceding entry and then the adjusting entry.
Hey, still for questions, because I got one more question.
Okay.
So I noticed at the beginning of the class you said like 3 times that cash will never go on an adjusting entry, right?
Yeah, an adjusting entry. It could be in the preceding or subsequent adjusting entry, but it is not to be.
So is that the same thing for accounts receivable?
I didn't say that.
I know you didn't say that. That's why I'm asking.
Okay. So account receivable can be an adjusting entry. It can be, remember we said a type 15 is a type of adjusting entry. Do we have these entries made? Do we have these entries made? The 2-minute rule still applies.
I think I got it. I think.
All right. Go ahead.
Okay, so supplies were purchased with cash. So that means the preceding entry is supplies is debited at 25,000 and then cash is credited at 25,000, right?
That's correct.
And then the adjusting journal entry will be supplies expense because we don't use cash. So it will be supplies expense will be debited at 20,000 because that's how much they would have spent. And then the supplies under that it would be credited at 20,000. So wait, the supplies balance would be 5,000.
Be 5,000. That's
Right,
how much.
5,000. And then the supplies expense would be 20,000 because that's how much they spent.
That's correct.
Oh, thank God.
Wait. Wasn't the supplies purchased on account? I'm reading that right.
It wouldn't matter. Okay, so it was on account, so you should have credited accounts payable.
Oh,
So,
okay. Accounts payable. Right, you're right.
whether it's purchased cash or accounts payable, the adjusting entry will be the same. See, if you buy with an account payable, you eventually got to pay the account payable, remember?
Mm.
So you're going to eventually pay cash.
Okay, I see that. But for the adjusting entries, you're saying none of that will matter because you wouldn't use accounts payable or cash as an account in the adjusting entries. You would use
Correct.
supplies expense and then the supplies anyway, right?
Correct.
Okay, just making sure I got that right.
Okay. Any other questions, comments? Okay. So we have 40 of these, and each team is to make sure everybody does one and be able to explain it to me so that when you have a quiz on adjusting entries in period 3, you can get at least one right. So you learn how to, learn how to do one thing. Okay. Learn how to make one adjusting entry because we will have all the types. And so if you learn one, then you might learn 2, then 3 and on. But the starting point, just like with making regular journal entries, you learn how to make your adjusting entry. So some of the adjusting entries are harder than others. So as you assign those adjusting entries, keep that in mind.
What is this labeled as under course content?
Where's what labeled as?
This these questions, like what is it labeled?
Not in course content, is in the primer. Get your primer so you can study and read and got all these examples. Done all the freeing I can do on copyrighted material. Okay, so we started adjusting entries. We'll go over these, plus discuss the next types. Then we'll finish up with adjusting entries on next Tuesday. Continuing, students who need to retake, students who are volunteering to retake, that will occur next Thursday. Let me grade them.
Thank God.
And then for students who are not retaking, they'll have a free period. Not this Thursday, but the following Thursday. Any questions? You have a free period, but you have your study problem for this material that we're working on now. You're supposed to have worked those study problems, the 40 journal entries, and gone through that entire process. You turn those things in. I'll be looking at those too. So there's a purpose in telling you to work that so that you would understand the process. So if there are any issues or if there are any questions, office hours will start at 1:30 tomorrow. I'll be utilizing the number for 02. I used the 01 number on Monday. I used the 02 number on Tuesday. So especially if you got questions, I've talked to you about the exam, go and work with it, and then have your questions then so we can go over it. And then if we don't get in it, we need to look at it a few minutes, we'll look at it. But the adjusting entries take some work and thought. Okay, so I don't want to get off track in terms of the adjusting entries so that we can get that out the way. Okay.
You said we retest on Thursday. You said we can retake the test.